Chapter 11, The Basics of Capital Budgeting. Introduction. What is capital budgeting? Capital budgeting is the analysis of potential additions to a firm's fixed assets, those long-term assets. Obviously, if we're talking about long-term assets, these are termed long-term decisions, and they affect or they involve very large expenditures. And they are very important to a firm's future. It is these projects, these long-term assets, which produce cash flows over an extended period of time. And we know that it is those cash flows that affect a firm's stock price. And way back in chapter 1, we said that maximizing a firm's stock price over the long haul was critical to maximizing shareholder wealth, which is the entire goal of the firm and its decision makers. What we're going to study in Chapter 11 will be various techniques for evaluating these long-term projects. But before we go forward, we need to define some terminology. For instance, some of these projects will be independent and others will be mutually exclusive. What does that mean? Independent projects are projects whose cash flows are unaffected by the cash flows of other projects. The acceptance of one does not preclude the acceptance of other independent projects. In other words, these are projects which do not compete against each other. If these independent projects meet a minimum acceptance criteria and the firm has enough money to pay for them, then they will invest in them. However, mutually exclusive projects are projects that do compete against each other. The acceptance of one eliminates all others from consideration. So when projects are mutually exclusive, we will choose the best one, the one that meets our minimum acceptance criteria and rises to the top of all the other mutually exclusive projects that we are evaluating. So the acceptance of one mutually exclusive project eliminates all others from consideration. Some projects exhibit a normal cash flow stream, while others exhibit a non-normal cash flow stream. What's the difference? A normal cash flow stream is one where we see a cost or a negative cash flow, a cash outflow at time period 0, followed by a series of positive cash inflows. So the cash flows change signs only once. There's a negative followed by some positives. A non-normal cash flow stream is when we have 2 or more changes of signs. There would be a cash outflow, a negative cash flow, followed by some positive cash flows, and then a negative cash flow, either to shut down the project or that might be necessary to crank back up the positive cash flows. So the sign of the cash flows changes more than once with a non-normal cash flow stream. Throughout Chapter 11, we'll be examining these 2 projects and applying the various techniques for evaluating which one, or possibly both, or none of these 2 projects will be acceptable to our firm. So let's eyeball them and see how these two projects are similar versus how are they dissimilar. Both of these projects are 3-year projects. They both have a $100 cash outflow or cost at year 0. They both exhibit a normal cash flow stream, a negative, followed by positive cash inflows. We don't know if they are independent of one another or if they are mutually exclusive and competing against one another. How are they dissimilar? Project L is a little slow to crank up in terms of the level of cash flows. Project L starts off with a very low cash inflow of $10 and then it gradually rises. So starts off low, its biggest cash flows occur 3 years into the future. Project S is hot coming out of the gate. Project S's cash flows are highest early on, 70, then 50, then 20. Project L is what we would call bottom heavy. Project S is top heavy because of when they experience those cash inflows, their greatest cash inflows.